Welcome back to the Property Frontline. Today I'm here again with Scott Hoaxang. Hi, Scott.
Hello, everyone.
We're here for Market Watch yet again, which we do monthly. And this Market Watch is a little bit different to what we normally do, and you'll see why very soon. But as always, what we're going to do first is review the Australian property market performance up to the 28th of February 2026. And then we will go into a big discussion about everything that has changed ever since the 28th of February. Right. As usual, we draw our data from the really reliable data houses of Cotality that we have found, or Scott's found issues in their data sometimes. But anyway, Cotality we use, PropTrack, and then SQM Research. So the combined data, which we put on a chart to help you compare so you get a really good view of what's really happening. Scott, can you take us through Sydney, Melbourne, Brisbane and Adelaide?
Sure. Thank you very much, Debra. Shifting over to our chart, these are February house price growth stats. Yep. We had a mixed bag on Sydney. Cotality had it slightly down, 0.2%. PropTrack, decent, positive 0.5%. And SQM was about flat with their asking price data. Shifting down to Melbourne, again, Cotality had a slight fall, 0.2% in house prices. PropTrack was slightly positive at 0.2%, and the SQM data was reflecting a drop of 1%. Our first BAP market, Brisbane, showing very strong growth here in the Cotality data, up a whopping 1.5%. Geez, that's almost 20% per year.
Yeah.
The PropTrack numbers have tended to be lower in some of these markets in the past. They've got it growing at 0.6. Really kind of who knows why. It feels like it was stronger than that to me.
Yeah.
And SQM had it just slightly positive at 0.2. And down to Adelaide, pretty good read there, 1.3% up from Cotality. Higher number there with PropTrack, 0.7%. So both data services had Adelaide looking pretty good, I have to say, and SQM was positive 0.4. We're going to shift back to Debra to take us through Perth and our other capitals, or let's call them closer to regionals, let's say.
Yes, and they are. So Perth, talk about a star performer for February, and really we know why, because it has really got some good capital growth drivers, really just pumping that market, and they still, it's still relatively affordable. PropTrack though, very different, with a positive though 0.7, and SQM with asking prices at 2.8. You just wonder where their cutoffs are, and maybe because it was such a short month, I don't know, that the data is so skewed. Hobart, Cotality has them up by 1.7, so that's performance for February, and then PropTrack has them up by 1.2%. SQM has asking prices down at 0.4%, so the owners of property in Hobart haven't got the memo yet that people are coming to buy.
Yeah, maybe people sitting for a few years and offloading too. I mean, yeah, right.
Yeah.
Haven't figured it out yet.
Yeah, that's right. The ones that bought in the last stupid false upturn, and now, yeah. Anyway, I'll try and not be sarcastic about it. Right. And now the very, very interesting data we've got for Darwin, which we triple checked, and so we don't know whether the data houses have got it wrong, but Darwin, which in January was up like 1.5%, February now, Cotality has performance at 0.1%. And this could be just that they had very few sales. There's only, 70,000 dwellings in that area. And if people, it's like very hot up there in February, and maybe they just decided they didn't want to sell. Anyway, we don't know. So we'll keep our eye on that market. Or the other thing, like Scott and I were saying before the broadcast, maybe everyone's wiped their hands of Darwin now and they're on to Hobart. Then, so PropTrack has Darwin up by 0.5%. SQM still really showing very active numbers at 2.8%. Canberra 0.9%. Like, who's doing that? Anyway, very small amount of property is available in that market.
Yeah.
PropTrack 0.2%, and SQM has Canberra down 0.5%. And they can see the national numbers, which we really don't give much truck to. On to the house price change graph. And this works so much better for someone like me. I am much more visual. But yeah, so Scott, is there anything that you would like to say about this slide?
Well, certainly we can see one market surging in the last couple of months. So its growth rate is increasing dramatically.
Yeah.
That is our friends out with Optus Stadium out in the West. And those lucky people out there too, getting to see the Matildas in their last couple of soccer matches. Lucky.
Yeah.
Um,
So we're talking about Perth there. Yeah.
There we go. Yeah, sorry.
Yeah. And Darwin, we can see really starting to turn down. So that's Perth, Darwin, Brisbane, Adelaide, and then we can see the others like merging together on the downward trend, like the Ray White economist narrator is calling it the K move. Like you can see it, K. Anyway, whatever.
Hey.
Yeah. So really, for me, this is all about affordability, because these types of markets, so certainly your Perth, Brisbane, like Adelaide, Perth and Brisbane are still affordable for a broader range of buyers. So they're still as hot as anything. All right. And so on to the rental market. Scott, what would you like to say about this?
If you watched our podcast last month, this is pretty similar. Very high rental growth in Darwin and Hobart. Brisbane seems to kind of be coming up a bit, so we may be seeing, starting to see those workers showing up to start in those big infrastructure projects would be one thing I'd be thinking about.
Yeah.
And what else have we got? Perth is sort of going at 6% as well. So good rental growth in both Brisbane and Perth is contributing to the prices. And then we've got slower growth down in Sydney and Melbourne. It's not zero though. I mean, Sydney's at 5% for houses and 6% for units.
Yeah.
So, I mean, from the high rents that exist here, that's still a pretty considerable increase. Melbourne running about at inflation. And we've been anticipating some rental growth to pick up in Melbourne. The concept is that prices have been low for a long time. Rents are extremely cheap. We've just done a few houses over there, 4-bedroom houses, and they've rented for $450 a week. I mean, how cheap is that?
Yeah.
Just crazy. And the people, the migration and the people are going to be heading there. It is just a matter of time.
Yeah, but that is the state where unemployment is rising the fastest. That's all I'm going to say. Like,
Yeah, the economy is not great, and I think we'll kind of leave it as that.
All right.
Maybe we should call it the Frankenstein market. I don't know.
Yeah, don't know. Okay, so what we normally do in Market Watch is we normally have a news segment, and then we'll have a deep dive into a particular area of the market. But with all of the changes that have occurred over the last 2 weeks, we've decided that we really just need to focus on the news, because Scott and I are just being bombarded by everybody asking us what's going on. So we're about to tell you. So the first thing is today, the RBA has just announced that they've taken the cash rate up by 0.25%. It was not a surprise, though, 4 weeks ago it might have been. Right. So, Scott, can you take us through the graph and also any other commentary you've got around the
Sure.
rate today?
On the decision itself, it was actually very close, 5-4, when you read into the minutes. So it was certainly not a slam dunk that they were all voting for a rate hike at this time.
No.
Maybe some of them wanting to be a bit cautious and give it another month. So much uncertainty with the conflict over in the Middle East. And there were some notes in the minutes of the RBA that talked about their concerns about rising inflation at the end of 2025.
Yeah.
So a lot of people want to just jump in and say this is all due to oil and Trump's war, but I think a lot of this was baked in anyway.
Yeah.
This chart is what the bond traders believe interest rates will be trading at over the next year. So you can look at the prices of bonds that are being sold out there and work out what interest rates are associated with them.
But
So
this is it's
sorry.
forecast only, so it's like the
Yeah.
the trader's best guess. Yeah.
Correct. People are betting money on this scenario. Now they may be wrong, and we'll talk to you about what this looked like before. But what it currently says is the market's believing we're going to get 3 rate hikes, including the one today, by this Christmas.
Yeah.
So certainly a lot more sort of fire in the cannon yet, it appears.
Yeah, so let's take it in detail. So they were betting by April, like March, April, we'd be at just over 4%, which now we are 4.1.
Yep.
And then they're saying there'll be another one in June. What you reckon? Just one more?
I think the second one was kind of June, July, August in that time frame, and then a
Yeah.
third one toward the end of the year.
All right. Okay. And then a bit of stability, because really you can't, like, the horizon is pretty hard to predict, isn't it?
Yeah. And we did go back in and review what this chart looked like when some of the forecasts were made last year. And the forecasts were down for rate
Yeah.
cuts. And the market was betting on rate cuts. So,
Yeah.
kind of the big picture here is no one knows. I mean, we just do not know. The best financial experts who are betting their clients' money on prices of some of these financial instruments got it wrong.
Mm,
And now we're sort of saying hikes coming.
yeah. And we'll talk about who else got it wrong next.
Yes.
Of course, what happened on the 28th of February, just as everyone was ruling off their performance data for February, Middle East conflict breaks out. And so we're now in day 18, and people are still just trying to figure out whether, it's really going to be very long, or whether it's really serious. And yeah, so I have my views, but let's work through it step by step. So first of all, Scott, can you talk about this great chart that we've got here?
Sure. I love this chart so much, I put it in. We've all probably seen the TV news that shows the Strait of Hormuz
Yeah.
over by Iran and Oman. And typically we see the one with the little ships moving through it. And they show fast ships moving through a month ago. And
Yeah.
now they show no ships
Nothing.
moving through. It's just
Except
stopped.
one green one.
Like a battleship board,
Yeah.
This actually shows the oil that's moving through there. Where's it coming from? So it's oil from Saudi Arabia, Iraq, the UAE, Iran's pushing some oil through there, but they're only the fourth largest producer, Kuwait
Yeah.
and Qatar. Where's that oil going? So we shift over to the right-hand side. It's mostly going to China and India. So the vast majority of oil coming out of the Middle East, 20 years ago, it probably was going to the US, but they
Mm.
have increased their production so much. It's only a very
Like
small
they
amount there.
knew, like they knew what was going to happen.
Mm. Maybe there was a push after the oil crisis with Jimmy Carter and so forward to do something about that. You see South Korea and Japan on there, and just a little bit of oil to Europe. It's just interesting that the U.S. and Israel are the ones pushing this conflict,
Mm.
and in reality, this chart kind of effectively says it was not of high strategic interest to the U.S. Uh,
No. Well, they're saying that they went in because Iran was about to develop nuclear.
yeah,
But before we talk about that, so the reason why Trump is now saying to China, well, he's asking the rest of the world to come and help the ships get through. But the reason why he's saying China come over and help is because they're the ones who are benefiting. He wants them to send ships to,
ships, or certainly money to pay the cost of the U.S. ships in there.
yeah,
Yeah, it's interesting if we could wind back the clock, and if I could tell you a U.S. president would be asking China to send ships into the Middle East a
yeah.
couple of years ago, just shaking my head.
It's crazy.
Yeah.
But where I was going with the United States not needing the oil, I thought Trump increased his activity on oil production like last year, but maybe,
Um, yeah, I think oil production grew strongly during the first Trump term.
oh,
It
I
actually
mean,
continued to grow through the Biden presidency,
oh,
and it's growing now under his second term as well. So, I mean, the U.S. has continued to produce more and more oil and become less and less dependent on the Middle East.
yeah. Oh, well, let's see what happens. Okay, let's work through it. So global markets, yeah. So each country, of course, is actioning their reserves. So everyone's being proactive about it. But those countries, in particularly in Europe, who really focused on switching to the EV network, they're the ones who are like, even less interested in helping out with the conflict, don't you think?
Yeah, absolutely.
Yeah.
Yeah,
Um,
definitely.
and then, so our situation in Australia, like the media is telling us endlessly, local supply, give or take 30 days. So what can we do about it? Now, the farmers are saying, well, you guys in the city take public transport or yeah, do a few other things and send like give preference to sending uh, petrol and diesel to the farmers. One of the other things that could happen is that we might end up with some uh, very familiar travel restrictions, but it'd be car based. um, and yeah, and so impact on property prices. Well, from my perspective, uh, we have absolutely not seen any change whatsoever. The really, really hot markets that I'm operating in are just hotter than ever. I thought we might have seen less cars on the road last weekend, less people at opens, but it was still crazy. Um, and what we might see, if anything, is that industry might revert back to their COVID operations, where the agents who loved it, all they had to do, they didn't have to run opens. They just do a video of the property and send it to all the buyers. And then a building inspector comes in to check the
Yeah.
property.
I mean, look, what one thing this country should be good at is not using a lot of petrol, because we did it for a whole year just 3 years ago. It's not that long ago.
Just 1 year? We did it for a year?
For about, I would say, for about a good year with the lockdowns and various work from home things. It wasn't much longer than that.
Well, Victoria did it for longer than that.
Well, they might have, yes, but
Yeah. But yeah,
anyway, yeah, I think in our space, in the new property space, a little bit of hesitation we're seeing. I think people are talking to their accountants and planners, maybe getting a bit of feedback from them, maybe just be a bit cautious, but it's not just due to the Middle East conflict. There's a number of other things that are worrying them as well. I think the lower end, affordable end of the market is likely still to continue to be strong, as Deborah's saying. It's
yeah,
going to be the pricier high end that's more impacted by interest rates. And this feeds into the story that interest rates are very likely going higher.
yeah. And of course, the other news is the property market doesn't change quick. With, like you don't suddenly throw your property on the market in 2 weeks' time. So there is that will moderate prices. But the other point that we were talking about is there's a lot of people who have a lot of equity now in property. And so those people will be emboldened to mm, operate, operate opportunistically. So
Yeah.
they'll be um, yeah, buying bargains where they can. So what I would like to say first up is um, up until the 28th of February, we saw that there was borrower lending increasing. So new housing in particular was up by 5% by number. So 5% more people than in January and December were getting their loans, but the value of those loans had gone up by nearly 10%, and a lot more first home buyers were getting approval, so they're on the rise. Scott, do you want to talk about the federal budget?
Sure. There's been a lot of speculation here on changes that may be coming to various property taxes, whether that be limits on negative gearing or changes to the capital gains tax. I've given up on trying to speculate on this stuff. We don't know what's strongly being proposed and what Labor can pass with whomever will join them in the Senate to pass the changes.
Mm,
We'll know shortly in about 2 months.
yeah.
There are some small tweaks that I actually believe make a lot of sense. And I think some people in the industry actually have went out there and said, why not change the capital gains tax so that you had to hold a property for 5 years or longer to get that full capital gains exemption?
Mm,
To a lot of us, something like that seems to make a lot of sense. Reward the people that hold long term, offer their properties out in the rental market, and maybe not give such a good deal to any property speculators and flippers that are out there for a short turnaround or a quick buck.
yeah.
But we won't get too political on that. We'll sort of know soon, but it has fed into the buyer hesitancy we've seen.
Mm.
People are worried.
Well, in my world, people ask the question and then buy anyway. They're like, we're ready to go, we're buying. Yeah, too many people have seen these sort of little blips come up. And if you're buying very well strategically, you're going to be fine anyway. Just don't buy in mining towns or weirdo places like that. Yeah.
And just
Um,
remember, any radical change that would happen can be reversed in 2 years at the next election, and that's the other thing,
oh,
that
from a legislation perspective.
absolutely. So anything radical that would really upset a lot of voters, I mean, can be reversed. And if people get the feeling that's what's going to happen, they're not going to sell.
Yeah. So the last point, um, we did have a real big deep dive into infrastructure planned, but now we've had to postpone that to next month. But I couldn't resist including this as news from February because everyone jokes about the high-speed rail network, just like we used to joke about the second airport in Sydney, which is now a reality. So now people can't, say that's never going to happen because it's happened. So now people go, oh, that high-speed rail network. Oh, like what a pie in the sky that is. But they are getting serious. They've even got a website now, and they've got an office in Newcastle. And in February, Albo announced the funding for the development phase of the Sydney to Newcastle line. So that's happening. And people can joke about it all they like. But when we meet next month, we'll talk about the pros and cons of what's happening with that. But now we're going to be on to our revised forecast for 2026 property market. This will be the third time. So get out your binoculars. Why yours one-eyed, Scott?
I've had to make some corrections to mine because some of the forecasts have been so bad over the past few months. I don't want to say bad. I mean, things have changed, but certainly there have been some mirages out there. So what I'm attempting to do is filter out the mirage with this Band-Aid over one side. So hopefully I'll be able to see clearly out the other one.
Okie dokie, let's see what we can do. So this will be the third time we've revised the forecast. Right. So the first thing, can I say, we're going to cover Louis Christopher's revised boom bust. And a lot of people will say to me, why do you always talk endlessly about that guy? But seriously, who else is getting us a halfway decent forecast? We like his approach because he does look at the market from a number of different ways. So he's even though he's had to revise it this time, like you mentioned, Scott, remember when we did the November boom bust and you said he hasn't got a scenario that includes interest rate rises.
Exactly. It was one of the first things we noted. I think we probably even said it in the podcast.
Well, you noted it.
Yeah.
I was busy going, oh, wow. So how should we tackle this? Which way? Do you want to take us for a walkthrough?
Sure. So, and we do like this about Louis. He does show his previous forecasts
Yeah.
and show directly how they change. You just don't find most of the other forecasters or banks self-grading themselves. So
No.
we will give Louis a pat on the back for that. There have been some major changes in assumptions, which are the reasons why he's changing his forecasts. The biggest ones are what's going on with inflation and interest rates. So previously, we thought, or at least the experts out there thought inflation was under control, was heading down into the twos, and we were expecting potential interest rate cuts. We talked to you about the future markets earlier, and they were pricing in rate cuts. And that led to just a very strong bullish forecast from SQM. They've had to do an iteration here. Louis calls it a data mirage in terms of what everyone was looking at. So maybe they saw something out there that faded away and ended up really just being sand. There wasn't actually any water there. So with the increases now expected in the cash rate and interest rates due to the much higher inflation, it's really caused them to lower their house price forecasts across most markets.
Yeah.
So we've got before and after for the different cities. He's got, just to kind of summarize it, he's got 5 that he's revised down. The 2 biggest drops are in Sydney and Melbourne.
Yeah.
And we've got an 8% change in those ranges. If you look at that, all the way from being definitely positive this year in both of those markets toward a real possibility that Sydney and Melbourne may fall, 4 to 6%.
I think if what we've seen in February for Darwin is the trend, he's going to be way off with Darwin because it could be those speculators are now, off to Hobart, which is not a great way for buyers to behave. I'll say that right up front. There's no reason to be trying to flip the market like that and we see people who spruik these big changes in the smaller markets as the people who are just leading people off a cliff. They're not being very responsible with their advice, and I'm happy to take on all comers.
Hmm.
And yeah,
Anyway,
so
I guess so the summary there across the capital cities, instead of 6 to 10% growth, he's got us at 0 to +3.
oh yeah,
Um,
capital cities, yeah,
I think you wanted to point out he actually included Sunshine and Gold Coast there.
yeah.
I had actually prodded Louis quite a while ago to include the Sunshine Coast in his reports. So thank you very much for that, Louis. Um,
Yeah. Yeah, because
and
those
he's got
markets are really changing. Yeah.
Y yeah, they are. They've just had such large price run-ups. I mean, he's got
Mm.
Brisbane, growing now faster than both of those 2, but in the past, I would definitely say they've outgrown Brisbane over the past 5 years.
Yeah. Yeah, for action, yeah, because they were so low,
Mm.
yeah, and so popular. Yeah, I still really think he's completely misguided with Mackay, but, I buy. He just types the numbers. Whatever. We'll
On
see.
to the banks.
Yes, onto the banks. Right. So now, so we can see here the revised forecast from CBA, ANZ, NAB, and Westpac. And so I'll just quickly run through these. So CBA has got mostly all areas still moving in a positive direction, with correctly, I would say Brisbane and Perth being the front runners. And then in 2027, it's for sure this will be revised, just moderate growth. Looks like they've just thrown in some numbers just to fill in the blanks.
Mm.
ANZ has, they're more conservative, but still has Brisbane and Perth still as up, being, the leaders, but I think they're misguided with Darwin there. And really, why is Brisbane and Perth so strong? It's really, they're still affordable. They've got plenty of land, so they're attracting really good demographics. So lots of jobs, lots of families. And so
Yes.
that's the reason why they're so good. Do you want to do NAB and Westpac, if you can see?
Sure. Just one thing about the CBA note, they do dial Darwin down to 4%. So,
Yeah.
uh, just kind of along the lines of what we've been saying,
Mm.
maybe some slowing there. NAB has Brisbane and Perth strong as well, followed by Adelaide, and then pretty low but positive growth in Sydney, Melbourne, and Hobart.
Yeah, it's still
We
moving in
won't
a positive direction. Yeah.
Yeah, and actually a speeding up. So they've got a speeding up there, at least for Melbourne in 2027.
Yeah.
So that's kind of interesting. And I think a lot of people, are thinking we will see a turnaround in that market eventually. But I think I'm seeing more of that these days, that the expectations for higher growth are now really not this year. They're starting to push back into next. Westpac had moderate growth forecasts. So they've got Brisbane and Perth under 10%. Um, Probably the only one that's that conservative, probably
Mhm.
overly conservative, and growth across the markets at a very low rate. So, look, we monitor all these bank forecasts. They seem to always come out after SQM puts their forecasts out, so they have got sort of something to look at and guide upon. Just included, I guess, in your knowledge bank, we give them less credibility
Yeah.
than than the SQM ones.
And of course, we would always say again, we are looking at the very high level of percentage changes. So places like Sydney have over 650 suburbs, and we know that the outer areas, so definitely Penrith City Council, Campbelltown City Council, and Wollondilly, a couple of others, they are still red hot, and Central Coast is really starting to move. but I think Maitland is really got, like, with that potential for the high-speed rail. So
Yeah.
what we're saying is, like, this is very high level, but on the ground, there's still an opportunity for extremely hot markets, where, prices are really still shooting the lights out. So you just have to be very careful. If you want to buy into a particular area, just make sure you do your due diligence. Don't just listen to an agent that says, um, this market's, like, they'll never say the market's going down, although
No, and
maybe
my
they're listening.
personal view is don't just follow the historical data, because it just seems like there's a rising number of data tracking analysts out there,
Yeah,
and they come to most of their conclusions by just looking at what's happened. I call it driving in the rear view mirror.
yeah,
Only looking there, you've got to be looking out forward in terms of what is coming, not only in the next 6 to 12 months, but what is happening in your market over the next 3 to 5 years.
yeah.
Those are the opportunities we're looking for. Good, consistent, medium-term growth.
Yes, correct. All right. So what else have we got? Oh, right. And yeah, so watch out for misleading data. Use trusted sources. And seriously, the portals are pretty good, at least for comparable sales. And also try and get some information from your local government on what's happening with jobs and what families are moving in, looking at the demographic side of it. Always conduct the financial pros and cons of any purchase. Um, Now factoring in just a little bit more of a buffer for the future interest rates, and make sure you use criteria that's tailored to your requirements. So don't use a strategy that's not right for you. Is there anything else you would like to say on that?
I will just emphasize cash flow is always king. Growth is very, very important. But if you cannot hold your properties for the longer term, you're not going to be the beneficiary of the growth in that property. So it's becoming more and more important to know your numbers, understand what the holding costs are of these properties, and have a buffer to govern for the unknown, or let's say another interest rate hike or two.
Yeah, and of course we're talking, like, that's great advice for investors, but for home buyers, um, it's there are some opportunities. We might see the market moving in certain suburbs from a seller's market to a buyer's market. So if you can see a little bit of an opportunity to make offers at the lower end of the price guide range, test out that um, in your market. Yeah. Okay, well, thanks very much for listening. As we've been saying, uh, really look in any type of market, whether it's going fast or slow. You really always should be very strategic. If you want some help, you can go to Scott, and you can find him at his Facebook page, Scott Property Coach, where he doesn't hold back on his opinions of things. And if you want some help from us at the Property Frontline, you can utilize one of our range of services, including our end-to-end service, which is called Buy Like a Genius, because you'll get optimum property selection, really good negotiating power, and a property that will typically be, well, the property will really match your criteria, and we
Mm.
buy property that's very, very resilient to any market changes. Details will be in the description box. So that's it from us. Join us again next month, where we will cover the big infrastructure episode, and there's just so much to cover. And Scott and I both love it because there's some really nuanced information you could get from all the projects that are being rolled out. So we'll cover off the key projects of 2026 and also the pros and cons with Scott and I will probably argue of buying new infrastructure plus lots more. Okay, so that's it from us. Thanks, Scott.
Thanks, everyone. Please don't hoard petrol. There's enough out there for everyone. If we don't, I'll buy jerry cans and fill them up at the same time.
Use public transport or the phone. Yeah.
There we go. Exactly.
Okay. All right.